there, my name is Elliot Tawanda Woninyika from the Chartered Accountants Academy, and welcome to this class session on transfer pricing. So you find that transfer pricing is a critical topic for your CTA studies, and it is also highly examinable once you get to your ITC. So the focus here is going to focus around transfer pricing issues from a management, accounting, and finance perspective. I know you also have covered transfer pricing from a taxation perspective, so you should be able to reconcile the two. How do we deal with transfer pricing from a taxation perspective, and how do we deal with transfer pricing from a management, account, and finance perspective? So you'd find that in the decision-making process, management will first want to say, we want to do transfer pricing, and they want to make a decision around that. Then they consider the math principles around that. But one of the key considerations will definitely then come through is taxation. So for the purpose of this class, what are our learning objectives? So at the end of this lecture, I expect you to be able to evaluate transfer pricing options between operational divisions. So the key word here is, are you able to evaluate? So let's say you are given option number 1. We are considering following this route. Is that a viable option? Considering a number of factors, both tax, strategic, as well as operational. So for you to be able to do this evaluation, you need to be able to calculate the minimum or determine the minimum and maximum transfer prices. Because at times you're going to find this in whereby you are asked, can you determine the minimum price, transfer price that should be charged? However, as part of this evaluation, we are also expected to be able to perform a qualitative evaluation of that transfer pricing. What are some of the non-financial performance measures that you need to consider in transfer pricing? Because you find that from a dollar amount, it may make sense to charge a certain transfer price. But when you then look at other qualitative factors, say for example, if that transfer price is charged from an overall company perspective is good, but from a performance evaluation it's not good, but the division is going to be considered not to be performing, yet that evaluation is based on a price that is not within their control. So now the most important question is, why should we even be worried about transfer pricing? So the transfer price ordinarily arises in organizations that are divisionalized or that have decentralized organizational structures. And it can also arise in a company group setup. So in your financial reporting, you've done your consolidations, where you're going to have a holding company with a number of subsidiaries. So you can find that these subsidiaries can be trading amongst each other. So the question is, when those divisions or subsidiaries are trading amongst each other, what are we going to charge each other? So whenever there's involvement of an exchange of goods and services between the divisions or subunits, we are then worried about at what price are we going to do these exchanges. Because obviously from a global perspective, the overall company would want to make a profit. Or if it's a holding company perspective, we are worried about congruence within the entire group, which is why we are then worried about transfer pricing consideration. So what are some of the key issues to consider in coming up with the transfer price? So the first one is alignment to the entity's operating environment and strategies. So the price that needs to be charged, it needs to be aligned to the overall entity's environment as well as strategic objectives. And once we have charged the transfer price, we need to be cognizant of the decision-making consequences of that transfer price. Let's say, for example, a management division A are charged a bonus based on the profitability. But if they are then given a transfer price which is going to compromise their ability to earn a profit, it may affect our decision making, because that decision may end up being penalized. But they are being penalized mainly because of a price that they can't control. But the most important thing is, whatever happens in terms of price, ultimately we want to maximize company profitability. Because as an example, we don't want division A to record a profit and B a loss, and it then resulting in suboptimal decisions being made amongst divisions, then compromising the company's ability to maximize on its profit. So the transfer price to be identified or used should be the one that enables a company to maximize on its profitability. Then in transfer pricing, they need to consider the behavioral aspect of whatever price we pick. So these are now the motivational factors and performance evaluation factors. So now that we've got this transfer price, and as part of performance measurement or evaluation, what impact is the transfer price going to have? Because, for example, if a company is going to be given transfer price that compromise on its performance measurement targets, is going to result in suboptimal target, the suboptimal behavior, whereby a division or a subsidiary is now more worried about its own performance at the expense of the overall company objectives and strategies. So, key goals of transfer pricing. The transfer price that should be used should enable the business to achieve goal congruence. What does this mean? We need to be able to have optimal decisions being made that enable the business to achieve its overall objectives. And also the transfer price that we use should enable fair performance evaluation, as well as it should be economically realistic. For example, let's say a company is structured in division, division A and division B. And division A produces goods that it can sell to division B. And division A, let's say, proposes a price of $10 per unit. But B and B can buy, if they go to the market, they can buy those goods at $6 per unit in the market. So it then means that the $10 that division A wants to charge division B is no longer economically realistic. Why? Because division B has got an option to go to the market and buy these goods at a market price of $6. So it means the transfer price should achieve economically realistic pricing strategies. And it should also encourage cost control, because we are going to look at various transfer pricing methods that can be applied, but some of them are cost-based. And the risk around cost-based is a transferring division may just pass on the cost to the next division and not worry about cost control. Then lastly, the goal of transfer pricing should enable the organization as a whole to preserve autonomy. Because why? One of the reasons why companies use a divisionalized organizational structure is to encourage autonomy at division level or at subsidiary level. So if there's too much control over the transfer price to be determined, then it can take away that autonomy, which is the original intention of having a divisionalized structure or a subsidiary structure. Now, let's look at the various types of transfer pricing method that can be used. The first one being a market-based transfer pricing. So this one applies whereby the goods or services being produced by the division or subsidiary which wants to transfer have got a ready market. So let's say we've got division A and division B. The question is, can division A go and sell its goods and services to the open market? And if that's so, how much will it charge? So that is the market price, less any selling and distribution cost. Because now we are saying if they're transferring the goods internally, they are not going to incur selling and distribution cost. So once you say market price minus the S&D cost, then we get the transfer price if you are using the market-based transfer pricing approach. Then the other approach that can be used, the negotiated transfer pricing. On this one, we are saying the transferring divisions or subsidiaries will sit down at the table and agree on a price. And I'm sure practically this has got its own issues, because coming up to an agreement can be a protracted process, which can then bring inefficiency in the business processes. Then the last approach, which is commonly used in practice, is the cost-based transfer pricing. So under cost-based transfer pricing, there are a number of approaches that are used. The first one being marginal cost transfer price. So marginal cost transfer pricing, we are saying the transferring division or subsidiary will determine its total variable cost of production. And those total variable cost of production are going to equal to the transfer price. So obviously, looking at this pricing method, what are some of the issues? It means division A will not necessarily have an incentive for cost control. Why? because they just know when they produce, they're going to recover their full production cost when they transfer to the next division or to the next subsidiary. So I'd want you to research more on the disadvantages or drawbacks of marginal cost transfer pricing. Then the other method would be full cost transfer pricing. Again, full cost transfer pricing, not necessarily foolproof. In this case, what we are saying, the company will then determine its full cost of production, including fixed cost, to determine the price that they will charge the receiving division. But questions may arise. So how do you account for fixed costs? But there are various ways in which fixed costs can be accounted for in determining the transfer price. Then the last method that can be used is cost plus markup. So cost plus markup, it's simply saying the transferring division or subsidiary will determine its production cost, then add a markup to its production cost to come up with a transfer price. So what are some of the issues? So it means from a cost plus markup transfer pricing method is commonly used whereby the transferring division is also considered to be a profit center. So they would want to make a profit on the goods or say that they transfer to the next division or to the next subsidiary. So the issue with this is, let's say for example, within the organization we create 3 divisions that need to goods are transferred from division A to B, from B to C, and at each stage a markup is being added. So what might happen there? By the time that we get to exit division C, we then want to sell to the market. The cost build-up may then become too much, resulting in division C then failing to charge a competitive price to the market. So that's one of the drawbacks of using cost plus markup transfer pricing. Now, in practice, what are some of the major issues then that arise from transfer pricing? So the biggest question that needs to be answered is, what is the minimum price that the transferring division should accept to still be able to achieve more optimal production and profitability? And what is the maximum price that the receiving division should also be willing to pay? So that is the dilemma. The transferring division, they are worried about the minimum price. The receiving division, they are worried about the maximum price. So from a transferring division, their minimum price is they need to recover their marginal cost plus any opportunity cost of the item transferred. So normal opportunity cost is if the transferring division does not have any spare capacity, the opportunity cost will be equal to the market price minus the selling and distribution cost to get the transfer price. Why? Because we are saying instead of selling to the market, the transferring division is now selling internal. So what they would want at a minimum is what they would have gotten if they had gone to the market, which is the market price less the selling and distribution cost to get the transfer price. Then on the other hand, the receiving division, they are saying they would want the lowest price at which they would want the lowest price which would enable them to achieve more optimal profit. So here the question is, what is the price that would motivate the receiving division to buy internally? So it then takes me to the next biggest question. What is the point at which company profit is maximized? So in making the decision on the minimum price and the maximum price, the key requirement is we need to maximize company profit. So we need to find or determine the optimal production that would enable the company to maximize on its profit. So first, step 1, determine the optimal production at company level. So let's say for example, division A, we've got division A and division B. Division A, they can produce 10,000 units. And division B, they also have got a production. Division B, the one then selling to the market, they can sell up to 8,000 units. So the question is, at what level does the company maximize its profits? Then we determine the required production at company level. Once you've determined the required production, you then now need to say what is the price the supplying division would be willing to accept to equal its marginal cost of production. Then on the receiving division part, what is the maximum price to be charged, which would result in the receiving division buying internal. And then it brings the concept of the net marginal revenue per unit. So from the receiving division's perspective, they are only going to buy, the maximum price that they are going to buy is the one whereby the net marginal revenue per unit is greater than or equal to the price that they are going to be charged by the transferring division. So our maximum price per se effect then therefore is the point at which our net marginal revenue per unit will be equal to or will be equal to the price that we are going to be charged by a transferring division. So what are some of the conflicts that may arise in transfer pricing? Or how do we resolve some of these conflicts? Because the transferring division may want a certain price, but the receiving division may not want that price. So in some systems, they then make use of dual rate transfer pricing systems, whereby you have got two pricings, one that is used to evaluate the performance of the transferring division, and another price which is used to evaluate the performance of the receiving division. But practically, this will give rise to a number of issues around how then do we keep a track of all this pricing and the information system design etc. The another way of resolving conflict in transfer pricing is we can transfer at marginal cost plus a fixed lump sum fee, which is now a standardized fee that is agreed between the two transferring divisions and agreed upon at group level. Now, from an examination perspective, what are some of the decisions that you'll be expected to make where you will be required to apply transfer pricing principles? So you may be asked to determine a range of transfer prices that would motivate two divisions to transact with each other. And the key thing is by maximizing company profit. Or you may be required to determine quantities to be produced to maximize company profit using a given transfer price. So now you go back to the transfer pricing methods and principles. What do we need to do? What price should we charge to maximize company profit? Or what quantities should we produce to maximize company profit? So these are some of the decisions that we are going to be looking at or that will be expected to make using transfer pricing principles. So the next step is that we are going to look at a question that addresses or that applies transfer pricing principles. But right now, I want to thank you for taking time to watch this video lecture. So do make sure then also take time to watch the example, the practice question that demonstrates the transfer pricing principles and how they are applied within the decision-making process.